I am Frank Hathaway, and good morning. Thank you for your time. Delighted to speak to you today. I'd like to thank the Swiss Finance Institute for the opportunity to participate in today's industry forum. This is the second time I've spoken to the SFI this year, so it is always a pleasure, and it's always a great audience. To understand a little bit where I sit on this issue of blurring the lines, convergence of public equity and public equity and private equity, I'm going to give you a little bit of background. I am the chief economist for NASDAQ, but it's a title, not a job description. I run a research group. We are not a traditional economic shop. I don't release reports on GDP. I do not try and dissect the latest statements from Yellen or Draghi. We're essentially a team of internal consultants, and we use techniques that are very common to what you've seen this morning for economists to evaluate our businesses, evaluate potential opportunities, evaluate what's going on in sort of the universe where we deal financial services, think about how to enhance existing products or develop new ones. From a strictly personal perspective, I was a trader in the 80s. I guess my contribution to the English language is I swear less than I used to. And I was an academic, and since 2000 I've been with NASDAQ, so I guess I'm about due to change careers again. So this notion of blurring the lines, convergence of public and private equity, what is it essentially about? First off, I'm not going to be an exchange guy standing here and saying private equity will become like public equity. Those of you in the audience are thinking probably from the title, if this is what he's going to talk about, it's not going to happen in my lifetime, I certainly hope, or if I can help it. And frankly, I believe you're right about that. I'm going to talk about this issue from the perspective of an economist. And you'll get a flavor of that as I go into the body of the talk. But what economists of all stripes and what's underlying all the talks we've heard so far this morning are about is that we focus on the efficient allocation of resources. And in the case of what we've been talking about today, it's capital that is that resource we want to have efficiently allocated. So then get back to the central thought about for this morning is private equity continues to grow. Can it avoid becoming more like public equity? Or will the sheer size that private equity is beginning to assume in the marketplace make it become more like public equity? This is essentially the curse of size Tim Jenkinson was talking about. I'm going to talk about how forces that are pulling private and public equity toward each other, forces that potentially are working to push them apart. Sometimes it's the same force that might act in two different directions. Sometimes it's the same force that is sort of going in the same direction, trying to reverse this trend. Since this is an industry forum, and I am an industry guy, I will talk at the end a tiny little bit about what NASDAQ OMX is doing in this area. What I'm not going to talk about is performance of private equity versus public equity. You hear that all the time from many speakers. I'm going to take this essentially up a notch, I think, and talk about it more, again, from the perspective of an economist and where this private equity business fits into markets and sort of some of the problems we've heard today that it addresses. I think the interest for you all, it's twofold. One, yes, it may be a business you have or a product you consume. I'm not going to be advocating that these things converge or even arguing that they necessarily will because I'm being nice. I'm going to make these points essentially because I think private equity fills an important role in a market. Now, to get the economist hat firmly jammed on my head, it helps us to complete the market. And I'll talk in a couple minutes about exactly what I mean by that. But generally, that's a good thing. Economists like complete markets. And the reason we like complete markets is an incomplete market, and I'm going to do this at a very simplified level, but an incomplete market results in an inefficient allocation of resources. A little more formally, but still not formally, if there's a shortage of investment opportunities, you wind up restricting individuals from investing in a way that provides them with an optimal outcome no matter what happens. That's the simplest way to look at that. And you may get markets that are incomplete for a whole variety of reasons that relate to market failures. If private equity became like public equity, the ability it has to help complete the markets goes away. It would have some of the same shortcomings public equity has that we've already been talking about this morning. that results in less efficient capital allocation. That's not a good thing. And quite frankly, given my view of how the world works, something else would arise that fills the role that private equity has today. And since private equity is doing what it does reasonably well, that next big thing would probably be what we get in economists call second best, and not as good as private equity has been in addressing the problems that I'm going to talk about. So I'm going to talk briefly about the role of private equity in the market, talk very briefly about the successes it has, and I'm going to talk about the pressures that are coming to bear to try and force this convergence. And they're essentially going to be from the government, they're going to be from the clients, and they're going to be from the internal forces that the industry is generating on and of itself, and obviously conclude at the end. So when we talk about the role private equity has in the market, as you all know very well, it is not an asset class. It is a business model. And you can have buyout funds, long-only funds. I'm going to include venture capital and what I call private equity. Long, short, macro, special situation, arguably even fund of funds, which really is a business model because it's as much about a means of access and distribution as anything else. So how did this business model help to complete markets, or address some of the incomplete market issues that existed in public equity? Markets fail to be complete due to a variety of reasons. I'm going to focus on two that, in my view, private equity has found a way to address better than public equity. First is the principal agent problem between the investor and the asset manager, or the investment consultant. And we've heard about that from Narayan and from Tim, and it's generally been a theme for part of this morning. What does private equity do? Well, it's put skin in the game, and it put skin in the game long before the regulatory reform around the global financial crisis led to regulators and legislatures talking about it. It doesn't solve principal agent problems, but it moves to address them. You have your own capital at risk, idea being get your incentives better aligned than a typical fee or fee and performance model. Not perfect, just better. The other thing to address, we haven't talked about it yet this morning, is a pre-commitment problem with investors. We all know investors, we probably behave this way ourselves, like to say, I'm in for the long run, and then change my mind. Long-term project, which could be a turnaround, could be simply a project with a payoff that's in the distant future, could be a long-term project that's designed to capitalize on some market inefficiency, some divergence between asset classes that shouldn't otherwise diverge. Could be a long-term project that is essentially trying to arbitrage some unsustainable macroeconomic policies. And we heard about that from Burkhard first thing this morning. If long-term funding from some of these projects it's not available, the projects don't get completed. You may get valuable products not brought to market. You may get market distortions lasting longer than they otherwise would. And obviously, as you all know, a typical PE model with long lockups means the investor really is in for the long run, or it's very costly to get out. So it addresses that issue as well. Public equity does not do either of these very well. The K review pointed that out quite clearly. The active versus passive debate we've heard about this morning, particularly from Tim, indicates a skepticism, perhaps well warranted, about the value of professional money managers who actively try and manage money. Turning to the investor side, because it's, and we all have some fault in this game, I suppose, as well as skin. Investors hurt. Not only money managers hurt, but investors hurt. And we see those kinds of flows at NASDAQ. Public companies manage to the quarter, to the analyst forecast. There are other short-term behaviors in investing that call into question whether companies are essentially being run for the long run. There are other benefits of private equity I'm not really going to spend any time on, but I just want to touch on them. Diversification, for those who are not liquidity constrained. Family business empire would be another way to do things if I didn't have alternative sets of money managers to invest for me. And then it also finally offers investments opportunities that would not necessarily be available to the near rich. So the rich, yes, can get into private equity. The near rich bundle, there's some other ways to get in. And all these things, again, from the economist's point of view, are a good thing. The success, I think you all know well. Level and growth of assets under management has been spectacular. $3 trillion, okay, an order of magnitude smaller than public equity, but it's still big, and it's above $3 trillion. Penetration of the individual investment community, all these consultants that we may question are at least putting a lot of their clients into private equity. Surveys on asset class allocations continually indicate that private equity is a growth area for them. And perhaps less well observed, but certainly remarkable, is the ability the industry has had to attract top talent. And it's one of the things that comes up in discussions about public equity. Are all the good managers going over to the private equity side? Now, pressures. Well, the biggest, what is driving this convergence? What are the forces that are acting on private equity to make it more like public? Well, if you're talking about things that are going to change an industry, you have to start with a government. Now, a government, we're going to have to start with taxation, and at a very primitive level, governments want revenue. The more potential revenue you have, the more interested the government is in you. So growth attracts attention. It takes the form of elimination of tax benefits, elimination perhaps of tax avoidance deferral schemes, scrutiny of tax havens, a whole bunch of issues. But you got money, somebody wants it. And if the government can say you have to give it to me, that's something they will be inclined to try and do. Regulation is another pressure on private equity to become more like public. A lot of this comes out of responses to fraud. Frauds raise questions in investors' minds. Is there investor protection here? Were the people who lost money truly those who could afford to lose it, or were somehow people who really couldn't afford to lose money caught in a fraud? The other thing that happens as a result of a fraud is victims advocates, and will look to establish a regulatory breach if they can, because regulatory breaches are easier to prove than fraud in many cases. And both offer an avenue to recover what your clients lost and get yourself paid if you're an advocate for people who are victims of these things. You also have regulatory reach for the same reason you have an interest from the taxation authorities. The bigger you get, the more someone will want to regulate you. This is just the nature of regulators and politicians. They want to regulate the next big thing, or they want to oversee the regulation of the next big thing. The global financial crisis created yet another pressure, that of the systemic risk, and whether some large private equity firms would be systemically important financial institutions. Probably not a huge direct effect there. There's probably some of it. More, I think, bigger impacts indirect on the private equity industry, but very direct for the banking industry coming out of the global financial crisis in that aspect of regulation where you're talking about Basel III and its effect on prime brokers, FACTA, other things that are affecting the banks. Clients are putting pressure on this industry, on the private equity industry, to look more like public equities in some respects. They love the results, or at least the early results. Again, I'm not going to talk about performance, I promised. And we love clients. We all love our clients. We love them all equally, but we know they're not perfect. We're never going to tell them that. The K Review in the UK talked about shortcomings in the investment process. It were shortcomings in the investment process, both in terms of how clients behaved and in terms of how investment managers behaved. Clients tend to be unwilling to monitor. There's a free riding issue there. We can understand that. May well be focused on the short term, susceptible to fads, these types of issues. All this potentially leads to demands for liquidity. And I said at the beginning, one of the things private equity does well is forces people to commit to the long term. But as a commitment to private equity increases, the demand for liquidity of my private equity investments also increase. Bigger allocations, more concern I get about liquidity, more pressure from the client side, I think as we're all aware, for liquidity. And the final issue I'm going to talk about, and sort of the problem that the successful industry has created for itself, is an oversupply of private equity services. Shortage of opportunities. We're well aware of the mountain of dry powder, which is often referred to in this industry, whether it's simply because too much money is flowing into it or it's the liquidity tsunami Burkhard talked about earlier on. Another question, I said, private equity has been one way to measure success. It attracts top talent. Quality of talent may be diluting, which has performance implications. All these factors are where this convergence comes from. And it's important as we move to thinking about what to do about it, at least for the industry, and essentially, and in part for NASDAQ as well, to recognize that we've been here before. Wealth didn't used to be taxed in the West. Regulation of wealth management is relatively new. The client issues are not new at all. I'm sure the Sumerians had to deal with it. And gluts in one particular type of activity are not new either. So let's just start with these for a little bit and talk about any forces that I can think of that might resist serve to resist convergence, because as I said, I think private equity serves a valuable role. Let's start with taxes. Don't you wish I had a magic wand about how to tell all of you to lower your taxes? And of course, I don't. The industry is working hard to maintain the status quo on tax treatment. And I want to come at this slightly differently. Who gets good tax treatment? Well, who tends to get good tax treatment is entities that create positive externalities. Charities are the big ones we talked to. We also have an advantage, perhaps, of a lighter regulatory touch. We talked earlier today about the bottom line for any politician is creating jobs. Okay? The image, positive externality is an image issue. It's a reality issue. There's a big bank globally running ads about all the positive externalities it creates. The industry, the private equity industry, has been active in that area, but probably not, at least from my perspective, not as visible as it might be. This is an area where there's going to be convergence, whether we like it or not. The question simply becomes how much. There's going to be more taxation for the private equity world. Regulation is similar, but one significant difference is in the regulatory area, you have the potential for self-regulation, which fundamentally is a bonding exercise. It is not simply replacing a government regulator with an industry panel. It's an industry panel that says, this is what our standards are. This is how we're going to behave. This is how we're going to measure how we do. And I will come back to that when I talk about the client side. So again, another area, there's going to be convergence. There will be more oversight of this industry than there's been. It's up to the industry to decide how far they let it go. The failing of the clients is essentially the issue the basic private equity structures were set out to address. If there's a good monitoring, you don't have liquidity, you don't have principal agent problems. If the long term really means the long term, you don't have sort of incompatible incentives over time. Liquidity is a big one. And another area where there already are efforts to create convergence between the two. And here I am going to put my exchange operator hat on for a moment. Exchanges came together in large part in their early days, not so much for people to yell at each other and buy and sell things, which is what I used to do all the time, but for the back office. That's where all the challenge is. And that's where the challenge is in the liquidity structures around private equity. It's a registry, it's securities transfer. These things are partnerships. The public markets had to solve this. They were able to do so. The approaches that work for them clearly don't work for partnerships because of legal and tax structure issues. But it's something that industries have had to address, and I think this industry will address over time. Secondary market, once you have an ability to transfer ownership stakes with reasonable frictions, then how do you go about doing it? Both these areas are areas where NASDAQ OMX is active, only very recently, and only in the United States. And as many of you know, if you don't have a license, you don't talk about your product in front of an audience. And we don't have a license in Switzerland or in Europe. So I'm just going to say we're working on addressing some of these issues in the States and leaving it there. The last issue that touches on clients is this oversupply, this money mountain. This is where I think some of the work we've seen today is helpful that Rick was talking about. Performance results, performance reporting. It addresses both the opportunities and the talent questions. Yes, it hurt active investors who weren't very good once we got standardized ways to report on performance in the public equity world. Might have been justified. Again, with the economic efficiency hat on, I think it is justified. So I think convergence here in terms of how you do and benchmarks for how you do and how you think about how you do in controlling leverage is probably going to occur and probably should occur. So you've got to get convergence in a number of areas. I don't view it as a threat. It's just to invest. It's just a set of forces that are acting to address some of the issues that have arisen as this industry has been so successful. It's a market-driven response. More generally, private equity itself is a market-driven response to the failures that the public equity world had. Frankly, I think both are a good thing. So just to wrap up and let us go have lunch, it's going to be convergence. Embrace, and to paraphrase the Irish mother's advice to her son, embrace what you must and preserve what you can so that private equity continues to fill the needs that it has evolved to meet. Thank you very much.